Welcome to our 2026 commercial real estate market forecast. I'm Kyle Matthews. I'm super excited for this one. I can only think of a few other times that the market's been wrestling with such headwinds and tailwinds. And I'm happy to share these insights with anyone that joined today or is going to watch this video after the fact. My commitment to you today is to provide valuable data, thoughtful conclusions, and get you out of here in under 30 minutes. If your attention span is like mine, 30 minutes at max. So let's talk agenda. Let me make sure my slides are working. Yeah, they are. Today we're gonna first cover the biggest forces affecting apartments, then retail, and we'll go into industrial and office. So we'll cover the four main food groups. We're gonna talk performance, pricing, and then we'll shift our focus to a quick overview of my expectations, not just for the economy, but the overall commercial real estate environment and deal activity for 26. So let's start. We'll start with apartments. We'll dive right into multifamily. The largest of all product types, and one that has perhaps been most impacted by the high rate cycle we've been all surviving, I'd say, for the last 3 years. So taking a look at the first slide, got it right here. Construction, there's good news on the horizon. If you look at the forecast for 26, multifamily construction is set to fall back to pre-pandemic levels. The pipeline is thinning. If you can acquire good assets now, you're going to be buying ahead of that window where competition for existing assets will be heightened because there's going to be less new product hitting the market. Now, if you look at the main problem owners are having, like in the Sunbelt markets, it's really the pressure on rents caused by this glut of supply, these new units. And in 2026, I think we're going to really start to see renters work through that supply wave. It hit in 24 and 25. And even, again, Sunbelt markets where you have population inflows, it just takes a while for that snake to swallow and digest that pig. So we're going to talk housing shortage. Let's look, long-term demand drivers for multifamily. They're still astonishing, based on current demographics and keyword like current. We aren't just short on units. The housing shortage is likely to grow by another 3 million units over the next 3 years. We're basing this off of population and marriage data. So this household number is really, if housing wasn't a hurdle, how many households would form. So based on the information we have, we aren't building enough housing for the population. Even in some of the cities that are recording record-breaking construction, like Austin, Texas, Nashville, Tennessee, here in beautiful Nashville, Dallas, Texas, we see the impact of the housing shortage, and we're going to continue to see it over the next couple of years. However, one thing I will point out, a touch on immigration. Now, I'm certainly not an expert on the subject. And candidly, I don't even know what data to believe, but the current administration, I believe they recently highlighted that they had over 500,000 actual deportations. And I think more importantly, they had mentioned something around, I think it was 1.8 million reported self-deportations. And so if these numbers are even remotely true, that will have a major impact on multifamily demand. And it would go a long way towards solving some of this supply-demand mismatch that we've been seeing for a long time now. And so next slide, we're looking at multifamily, the annual rent growth. We've had a high demand market in multifamily. Obviously, there's no just one big macro market. We have coastal markets, we have Sunbelt markets. They all operate differently. But, we've had that supply growth in 24 and 25. And the national number, if you look at the major metros, it fell from almost 20% in 22 to nearly zero in 24, 25. And we think we're going to see this number start to increase next year, mostly because if you think about what make up these lines, you have the low supply metros like New York City, the Bay, where rent growth is actually pretty solid right now. Then you have some of those markets like Nashville and Austin where rent growth went negative from the sheer volume of new units. So in 2026, we think we'll see the rent numbers in a lot of these Sunbelt markets, again, move back to moderatively positive territory, which will push up the national average. Again, Sunbelt markets being negative is kind of bringing down that national average. I think the slide's showing about 1%. As Sunbelt markets move back into positive territory, you combine that with much higher, in the positive sense, coastal markets, and we're going to see this number continue to grow. One of the things I love to talk about, moving to the next slide, REITs, it's from an industry standard, like people want to be in real estate. They want to get more real estate, but to purchase properties, it takes a long time. A lot of times people's first foray into commercial real estate investing is going to be by buying REIT properties. If they want to own a certain product type or a certain market, they can acquire a share of a REIT that has a concentration in those. So I thought for this Q4 webinar, we'd take a look at how some of the top 10 REITs per product type based on revenue have been doing, some of the numbers they show. So, again, we're going to start with here's 10 of the biggest multifamily REITs in the country by revenue. If you were to look at who grew the most in 25, you're really going to see those rent trends in actions. If your target markets were high-end renters in coastal gateway cities, you had a great year. We highlight EQR, Essex, Veris here, but really the trend was clear. And then most of the Sunbelt dependent players, they saw tougher years. And then we go to the next slide, the actual performance of the stock. Now here is the same REITs sorted by stock performance year to date. Elms here at the top. One thing to pay attention, it's in red because the previous years, going back to the previous slide, they had a pretty soft rent growth, but they're at the top in terms of dividend. That's just, they gave a huge dividend based off a major asset sale. So I'd argue for the audience, you could ignore that figure for now. It's not based on a normal circumstance, but the multifamily REITs, they took a step back in 2025. And in my opinion, this makes total sense. It's, there's a rise in vacancies, rent growth near 0%. But Matthews, the company, our C-suite, me personally, we're very bullish on multifamily, at least, for the next 5 to 7 years. There's just too much structural demand built into the demographics. So if you're looking at a REIT like Veris, where their revenue is up almost 8%, they're focused on an exciting market like Northern New Jersey, super supply constrained. There's even them, as strong as their operational numbers are, even their stock pulled back 11%, okay? Their debt situation driving the stock to dip a little, but we do see the 10-year lightening up. We see financial markets loosening. I think if those things continue on, who knows what will happen. Essex, Avalon Bay, they give you, if you to buy some of those shares, they give you access to some of that coastal market without the debt concerns. But, because of the regulatory environment, maybe your upside's a little lower there, a little more highly regulated. So let's talk predictions. All right. So where's the opportunity in 2026? I get that question a lot, so here's my answer. Because of drop in construction, that's happened over the last 18 to 24 months as rates have increased, as cost of materials increased. We see vacancy tightening next year. My team out there sat down, went through it with them, probably around 30 basis points or so nationally. Again, market specific could change, but about 30 basis points nationally, could be more. Immigration could be less. We expect the national average rent growth to return to firmly positive territory. And we see that being somewhere in the normal, what I call historically normal 2 to 3% range. But this could really accelerate in 27 and 28, because if you look at the pipeline being further out in terms of number of units delivered, it's even thinner. In 2026, I specifically love Northern New Jersey. I like Sunbelt cities where construction has slowed. They're digesting the supply. And the units being delivered, it's slowed down the fastest. And those are markets where pricing power is in the process of slowly returning to the landlord. And once that happens, you're going to see the demand drivers are still the best in the country. I'm also hearing a lot more about this regulation gap with markets, okay, especially with developers. There's going to be more capital competition in markets where investors aren't worried about local policy risk. Obviously, everybody's been talking about the election in New York City. That's kind of the bellwether, the bell cow for in terms of what people look at. But it's not the only city that has some concern from the development community and landlord community in terms of a regulatory risk. So this has been a trend for a long time. We're just seeing this increasing further as the divide in the regulatory climate between what I'll politely say is coastal cities versus maybe Sunbelt and interior cities widens. So that's multifamily. Let's move on to retail. Again, we want to move through this relatively quick, okay? My background's in retail. It always makes me happy to see how prominent it is in commercial real estate, how healthy the operations are. Just, it was a tough 15 years there from like 2007 to like 21, 22. And I just got back from ICS. I could tell a lot of the operating REITs, a lot of the larger owners were very happy in the retail space. And really, it's been a consistent winner the last couple of years. So let's talk about what drives retail. We're going to start. Check out this slide. Millennial aging, demographics. Okay, the engine driving retail, it isn't just the consumer, broadly the consumer, it's millennials. And as you can see here, millennials are about to age into their peak spending years. These are peak spending years because it's when professional incomes rise and people form families and they have kids. And I tell you, as a father of 4, kids are expensive, right? I'm always spending money, blowing money fast on my kids. That's half the reason I got to work nowadays, So this is a massive demographic tailwind. As this generation forms, households and families, their spending increases, groceries, furniture, activities, home goods. Millennials being such a large group, it really in my opinion, is going to insulate retail from any minor pullbacks in average spending. Major recession, all bets are off. But any minor pullbacks, any blips, I think because of this kind of surge in millennial demos, I think retail is pretty well insulated. Retail, let's talk sales. The data backs this up, okay? Retail sales have continued to rise all year. I personally, early this year, I was like, okay, retail sales is finally gonna, start to kind of peter out, and it might even go down. I've been wrong, and so finally, I'm converted. Retail sales are just gonna keep going up. In fact, total retail sales, I think they're up 42% compared to pre-pandemic levels, which is wild. Even better, the NRF is predicting a historic milestone. I saw this, I don't know, it was Wall Street Journal maybe the other day, the first ever $1 trillion holiday shopping season. $1 trillion, a little Dr. Evil line for you. If we were in a recessionary environment, we would not be seeing spending hit these records, okay? Just straight up. People talk about a K-shaped recovery, and certainly, the lower income earner might be feeling pain, but the economy more broadly, the numbers show just a general growth, general strength in people spending. Now, people are cautious about the future of the economy. You see that in some of the sentiment reports that come out, but all of the data, it just keeps showing, at the end of the day, it's people shows that with their dollars, they feel good because they keep spending it. So retail sales, that goes next to retail rent growth. If sales are good, rent's good. So we have the retail rent data broken out between STNL and multi-tenant on the slide, multi-tenant centers. This it's very stable. And it's very stable, in my opinion, because of long-term lease agreements that exist in retail. That's why you're going to see more stability in long-term rents in retail versus a multifamily where the leases are turning every 12 to 24 months. Retail, it's 5, 10 years. So as you can see, there's a slight pullback right now after that kind of post-pandemic boost. I mean, so much money was flown out there and it's kind of been spent, but it's still very healthy. And our prediction for next year is that we're actually going to get back to that pre-pandemic average somewhere in the mid twos. So that's good news for all my friends in retail. It's good news for the operators, good news for the tenants, good news for the brokers, most importantly, the brokers. But no, good times continuing for retail. That's what we see. Pulling up the retail REITs, a lot of my friends in here, so love them all. I'm just stating facts here. Top 10 retail REITs by revenue. If you take a look, revenue was up year over year at 9 of the 10 largest retail REITs. Now, it's hard to single out any real winners when they're all seeing such strong returns, but if you look at who grew the revenues the most, Agree, my buddy Joey's doing a great job, and some of the other more high-end retail-focused operators have had massive years. So this is the year-over-year change in their revenue. Let's look at their stock performance. Now, again, there tends to be correlation here. Retail was a much easier sector for investors to figure out, and the top performing REIT on revenue saw their financial return rise the most. And, unfortunately on the other end, Kite had that negative revenue figure, and it's the bottom list there, but I'm a big believer in Kite. They got a great portfolio. They're going to do awesome. I think this is just a blip. So let's make a couple retail projections. Sorry, my phone's buzzing. A couple retail projections. Our outlook for retail. Let me get to the slide right here. Look, yeah, I'm very bullish, and it's not just because I'm a retail guy. I'm not just drinking my own Kool-Aid here. We really think the economy will enable growth for the consumer. We expect consumer spending to stay robust. We expect it to continue to grow somewhere in that 3 to 4% range. We think rent growth will move back into that more normal, kind of just above that historical average of 2%. A lot of the information coming out from REITs in their earnings calls, that same store sales are just crushing. They keep outperforming even their own internal assumptions. So we feel really good about some of the urban retail near office hubs. I think office attendance is going to, and I'll touch on office in a second. I think office attendance is going to keep climbing. In fact, a little preview, I think office attendance will be the highest it's been since 2019 next year. So that's going to help some of the retail in those more urban locations. And it's going to continue increasing foot traffic at those kind of lunchtime and happy hour retail venues. It especially helps high street retail because high street retail has had a tough time of it the last couple of years. So before we get to office, let's talk industrial. Industrial is as tough as it was for retail 15 years. It was that easy in industrial, right? I always say, if I die and come back, I'm coming back as an industrial broker. But industrial has been awesome. So, industrial, every product type is affected by macro trends. Certainly, the tariffs. What was it? Liberation Day. I was going to say Independence Day. Liberation Day. in April, freaked everyone out. But, I think it was especially a volatile year for industrial sentiment. We saw the average UF tariff rate, as you can see on this chart, spike to 14.5% after Liberation Day. Initially, this sent the market into like a panic, I would say, and their fears trade barriers were going to crush logistics and demand. But the market reaction was, especially early on, it was mostly emotional. As the dust settled, we continue to see this reshaping of the supply chain in a way that benefits domestic industrial real estate. Okay. Next slide, just talking on industrial REITs, contrary to the panic, the Liberation Day of new trade policies, it actually strengthened U.S. industrial fundamentals. It accelerated nearshoring and reshoring, as companies move manufacturing back to North America to avoid tariffs, the demand for logistic networks, factories, supply chain technology, it's all surged. So Prologis, obviously Prologis is, in my humble opinion, the gold standard. But for industrial REITs, but Prologis and other industrial REITs, they've been crushing it. The real strugglers in the industrial space were more the niche and specialized funds. The cold storage providers underperformed slightly in 2025, as did the regulated industrial specialists, like LXP. But industrial REIT performance, like retail, the industrial returns, they aren't moving on speculation. So they're moving on results. Given the shift in global trade, I'm super bullish on logistics. I mean, who isn't? And supply chain related industrial, also very bullish on that, even after a strong 2025. And I'll show you in a second. We're about to take a look at a few maps that are going to explain why. So this slide right here, again, REIT performance in terms of the stocks, it's just, it's been a very, very good run for some of others. They got to figure it out. So here's a chart that I found fascinating. All right, my team put this together. We sat down, went over this, and I was like, man, it just tells such a clear as day story. This map's like, it's the most important visual for industrial investors right now, in my opinion. So since 2019, we've seen a definitive shift occur. Okay, the ports of LA, Long Beach, West Coast ports, they're still reporting positive growth, but barely. All right, the real volume has shifted to the East Coast and the Gulf. You look at land cargo crossing, like, so slide on land traffic shifts. Like, while that was happening at the port, simultaneously land cargo crossings on the Mexican border, those are surging. If you're looking for where demand will surge, the cargo is moving east and south. These are the data points that will determine where industrial tenants will want to be. Well, industrial tenants, where they want to be, that infects industrial rent. So let's look at some industrial rent trends. You see the slide, industrial annual rent growth. Like retail, we've seen rent trends in industrial stay positive, but dip after the post-COVID boost. We see this number also looking more like a normal kind of pre-pandemic year in 2026, with some of the Gulf and East Coast markets leading the way on top of that, and maybe a little more softness out west. And, we're showing about a 1.6% right now. Again, we see that kind of getting back to, something, a couple points higher than that. Couple predictions for industrial 2026. We expect operators, investors fully accept these new supply chain dynamics. We expect the strongest year of industrial leasing since 23. We expect developers to recognize the opportunity created by shifting supply chain. But for next year, we see completed space going down. Consequently, we predict a massive wave of leasing and asset appreciation, specifically concentrate along the Gulf and East Coast. All right. The real estate has to eventually catch up to the shock and shift that is higher tariff. It's not a collapse of industrial real estate, not anything close. It's actually a boost and a shift, a lift and shift, I think I've heard it called. So Texas and Arizona also stand to gain from some of that manufacturing moving away from China and Mexico. So those are a couple markets to keep an eye on. All right, moving on. Last product type, office, baby. I've been singing office praises for a year, 2 years, and I'm not a contrarian by nature, but I'm feeling pretty good about coming out in support of office over a year ago. So originally, I wasn't even going to include office in here, but I decided to add it in. Love office. I know it's been kicked around, been on the ground for a couple of years, but I see it coming back. And so let's dive in. Here we go. Office vacancy trends. This actually doesn't help my argument, right? We see these office vacancy trends. Everyone's seen this graph. Office vacancy spiked once the pandemic started, and it's been on a steady climb ever since. This number is even worse depending on the data provider and how life science assets are classified, but the trend is consistent. Office vacancies up, right? All right. But check out this graph. Look at this. You look at Class A. 2010s and newer construction. The 2020s have been huge for performance and leasing. So yeah, you put in older product, B and C office, the numbers are terrible, but Class A, this tells a totally different story. Very few new offices are going in, and competition for good space is ferocious. I'm in the office market trying to lease space for Matthews. You'd be shocked. It's not fun. I thought I'd go in, I have all the leverage, get this great deal, and especially these Class A buildings, Matthews, we like to be Class A. It's not great being a tenant. I'm not gonna lie, you landlords, you guys drive a hard bargain, but you wouldn't believe the level of competition for the most desirable buildings. It's hard to get, and that is not the narrative you hear macro. If you read, Wall Street Journal or something, they're gonna, it's a office apocalypse, all that. Again, maybe B and C product, maybe it is, but Class A is doing pretty well. So let's take a look at Mortgage Bankers Association Office Originations Index. Okay, the lenders have figured out that Class A is actually pretty good. According to the Mortgage Banker Association Index, origination for office deals and loans are back to 2022 levels. And I predict we're going to see more deals in general on both ends of the office spectrum this year. Okay, you're going to see an increase in deals for outdated buildings with plans to repurpose, reposition, tear down, convert, whatever it ends up being. And then you're going to see investors scoop up some of the top performing assets while national sentiment maybe hasn't caught up. And you're going to be able to get some of these Class A offices that actually have a pretty high occupancy, but still have a meat on the bone. You're going to be able to get in there at really attractive going in yields, okay? And replaceable rents, which is the most important thing. With some office predictions, okay? We think we're going to see the biggest companies in this country, the ones who are still adding workers, continue supporting those high-end offices in gateway cities. We expect more office deals in 26 than any year since 21. We think net absorption will come in above 0 next year. That's a big thing. And this isn't as much a prediction as an interesting trend we've noticed. If you look at the job posting trends, new roles are in person, not remote. 2025 layoffs will largely be seen as a churn from remote employees to in-person ones when we look back on it in 12, 24 months. So let's talk kind of high level macro economy and market predictions. We looked at the 4 main food groups, but we want to zoom out a bit and give a more broad look, and then ultimately some more broad predictions. I just touched on job cuts and layoffs and how remote work tied into that. All right. But this was the big news this year. Spring was the peak, but in October, we saw Amazon, we saw others kind of reignite the pace of job cuts. While painful for the affected workers, this softening, just from a data point, I want to be considerate that people lost their job, but from a data point, it was necessary to realign the labor market. Okay. And this is where you see it on this slide titled, but labor markets needed softening. We had 6.1 million more job openings than unemployed workers just 3 years ago. That is a massive, massive labor shortage. And that makes fighting inflation, I don't even say super difficult. I'd argue impossible. Okay. But now we're seeing job openings versus unemployed people is returning to a normal level. Wage growth is moderated. The ratio of openings to unemployed that's back in balance. This means the heavy lifting of economic correction is largely behind us. Labor market's really showing all the signs of a soft landing. That would be awesome. That's what everyone's rooting for. The current labor market is normal. That's a good thing. I repeat, it's normal. You see that little graph. There's 2 graphs, the one on the left, that blue and black line sitting right on top of each other. That's a balanced labor market. That's a good thing. Anyone pushing the narrative that this is a bad labor market is either being political or has only experienced working in the post-pandemic landscape. And that's not reality. When you print $7 trillion of money and give it to everybody by way of stimmy checks and PPP, this is what happens. So hopefully we don't do that again anytime soon. Final predictions. All right, let me wrap it up. I want to start. I'll go off the slide. So here's the bottom line of what we see happening. Okay, labor market back in alignment. Inflation will return to more normal levels, more normal, right? With some slowing in February, March, and a final kind of decent, mid-late summer. January, February, March, month over month CPI in 25 were huge. So as those months roll off the trailing 12, I do think you're going to see the top line inflation number come down. Economic growth estimates, I think they point to a strong year for U.S. and after the December meeting cut that just happened a day or two ago. If you read the FOMC notes, we're seeing a divide between Fed projections and market expectations. So the Fed forecasted one cut, market expects three or four. We're going to split the baby here. We'll split the difference. We see two cuts next year. So as of today, we expect 10 to 15% increase in transaction volume. That's good for brokers, right? That's good for buyers. It's good for sellers. It's a pretty healthy market. Any industry where you say, hey, there's going to be 10 to 15% more sales, more revenue, more trades, I'd say most people will be like, yeah, sign me up. That's pretty good. Obviously, if the Fed cuts rate more strongly than expected, or what I actually keep an eye on is engaged in some heavy QE, that number is going to go up, especially from a QE perspective. If they attack that long end of the yield curve, they try and bring down that 5, 10, 30-year treasuries, you're gonna see the market rip. All right. And again, we would revise these numbers up. For us in the commercial real estate world, we expect institutions, REITs. I got back from New York. I was more retail. I talked to multi, I talked industrial, some office. Everybody's expecting to ramp up activity over the first half of next year. And then at some time in 2026, we see the private market following their lead. So due to the timing of these recoveries, we expect cap rates for those top end deals, to compress, fall 25, 50 basis. So a little bit of pricing recovery, off the bottom. But again, that's more of the extremely high quality A asset, institutional assets. While we still, we see a little contraction in cap rates, so a little improvement in pricing in the smaller middle market private client deals, but not much. We see values staying relatively close to where they've been now for the last 12 to 18 months. All right, last slide, closing slide. That's all I got, guys. Be sure to, Zach, subscribe. Zach loves it when I say this. Subscribe to the newsletter. That's something we just launched, what was it, 3-4 months ago? That's been awesome. The feedback's been great, cranking out content as it relates to news, data, and commercial real estate space. So subscribe to the Matthews Market Pulse newsletter. So check out the podcast. Podcasts we interview, Matthews Mentality Podcast. We interview all types of people. Obviously, there's a lot of real estate folks who come on. And so, and of course, contact a Matthews agent today. Don't wait for tomorrow. Don't wait for January. Contact them today. If you need a BOV, if you want to know what your assets worth, you want to know where rents are, what type of debt is out there, you want to raise capital, or you just want to talk to a really nice guy or gal, you just looking for someone to have coffee with, they are available. Give them a call. I'm sure they'll be calling you shortly. That's what we do, baby. Cold calls and closing. So anyway, I hope you have a Merry Christmas. I hope you have a Happy Hanukkah. Whatever you celebrate, I hope it's happy and you had a great 2025. I wish you healthy and prosperous 2026. And we look forward to seeing you in the first quarter next year. Thank you.